Hey, what's up? My name is Monica Wilder. I'm a real estate broker. I also own my own real estate brokerage, People First Realty, here in Middle Tennessee. And this channel is all about me helping you navigate the world of real estate so that you can either buy your first home, sell your first home, or make that first investment property decision. Thanks for tuning in, and I'll look forward to seeing you here. All right, so you don't know anything about how to buy a house. This is your first time at the rodeo, and you need it broken down step by step. This is that video, okay? The first step being check your credit. It may be scary, it may be intimidating, but you gotta check it. And just remember, you are not your credit. Don't internalize that number and turn it into you being this horrible person if it's a low score. None of that. Just check your credit. Okay, now that you've checked your credit, if your score is above a 620, then you're good to go. There's gonna be a lender somewhere that's gonna be able to find you a mortgage to get into, no problem. If you're between a 580 and a 620, there's still a possibility that you could get a mortgage. As a broker, I get emails from lenders all the time telling me about their loan programs for the people with the lower credit scores. Don't feel like you're completely ruled out if your score is a 580 to a 620, but you will have to have more money saved up. So if that's you and you don't have at least say 10 grand in the bank, I would not even try to start looking for a house. But if you've got a lower credit score and you've got 10, preferably more $1,000 in the bank, then I would encourage you to give it a shot. You're probably gonna come with higher interest rates and you're probably gonna have a lot more money that you need to have saved up. So just be prepared for that. For all my folks over 620, the next thing you need to do is to get your paperwork together. Okay, what paperwork do you need to get together? So your last 2 years of taxes, you wanna have all pages of your tax return. Get those 2 years together, sit them in a file. The next thing is your last 2 years of W-2s, which should be pretty close to your tax returns because they should all be in the same general area. And put those in the stack with the taxes and sit them in a file. Next, you want to get your most recent 30 days of paycheck stubs. Now keep in mind, if you've been, laid off or worked reduced hours and things like that on the last 30 days of your pay stubs, the underwriter is going to want an explanation as to that. So you might want to write a brief letter of explanation explaining any challenges in your income in the last 30 days. Or just wait until your income is back at normal before you go make application to the lender. That way the most recent 30 days of pay stubs reflects your real salary, okay? Now, after you've gotten your W-2s together and your most recent 30 days of pay stubs together, you also want to get together your bank statements. Now, here's the deal with your bank statements. Your bank statements are going to tell the true tell when the underwriter starts to look. The bank statements are going to show when you get your direct deposit, what happens after the direct deposit hits, if you have been, getting hit with a lot of bank fees. All of that information is very visible in your bank statement. So be sure when you're ready to apply for a mortgage loan that you have what I call clean bank statements. So if you're one of those people who has trouble with bank fees and overdraft fees and all of that, you need to get all of that together, clean all of that up before you even think about going to the bank, okay? Okay. So we've talked about getting all of your paperwork together. That was your W-2s, 2 years, your 2 years of tax returns, your 30 days of pay stubs, and we also talked about your bank statements, making sure you have at least 30 days of bank statements. Now put all of that to the side, okay? Don't give that to anybody unless they ask for it. Just get that information together because it's gonna be definitely something that's gonna be needed as you move through the process. Now, income. When I worked in the nonprofit world, I have a background in nonprofit lending. We did what we call a manual underwriting on files. And what we looked for was consistency of income. And what that means is we want to see how long you've been on your job, and because that gives us the best indication of how long you plan on being on your job. So consistency of income to us looks like the last 2 years of history has been either at the same company. Maybe you've gotten promotions and your job title has changed, but that's okay because you're at the same company. Or maybe you have switched companies, but you're doing the same thing for the last 24 months. This is very important because it goes to your consistency, okay? Consistency of income. So after you've checked your credit, if you got the 620, so far so good. Even if you don't have a 620, you probably could get through the cracks somewhere, but you're going to have some money, more money saved. And then the next step is consistency of income. So if you've been on your job for the last 2 years, consistently, then you're probably going to be okay when it comes to the underwriters looking at that. So the next thing is your debts. Here's what gets most people. Some people have excellent credit, but they have a lot of debt, and their income is not enough to support that debt plus a mortgage payment. Okay? So that's a big important factor for you to consider, because even if you have a perfect credit score, 850 credit score, if your debt to income ratio is 55, 60, 65%, that means that the lender is not going to be comfortable giving you a mortgage. And if you're not sure exactly how to go about calculating that, here's a quick lesson. When you calculate your debt to income ratio, be sure that you add up all of the debts that you have coming out of that report to your credit bureau every month. So what are these? These are car loans, student loans, credit cards, installment loans. Anything that physically reports to the credit bureau every month, you need to add up and see what that total number is. Once you've totaled that, then you need to put that on top of a fraction and just let it sit tight, okay? That's your debt. Then you're going to come over and you're going to get your income calculated. For now, we're just going to use your gross because it's just easier to use. Figure out your gross annual income. You know what that is. That's what they said that they were going to pay you when you took the job. Divide that by 12. That's going to be your gross monthly income. Take that gross monthly income number and put it on the bottom of that fraction. So now you have debts on top of the fraction, and then you have income on the bottom of the fraction. Divide. Once you divide that number, a little decimal will come up. If that decimal is, 0.33, 0.35, 0.4, those are all good numbers. If your debt to income ratio is already 0.5 or 50%, then you need to reduce your debts before you try to go add a mortgage, because most lenders are not going to give you a mortgage that takes your debt to income ratio over 50%. And if you come to them at 50%, there's no room. They don't have any room to give you a mortgage payment. It's not going to be their fault. They're going to look at your credit score and say, hey, yeah, you got great credit, but your debt to income ratio is completely way off. We've got to either reduce your debts or you got to bring in some more income before we can approve you for a loan, okay? So there's a whole nother video I can do just on debt to income ratio alone, but just be sure to check your own debt to income ratio using the instructions that I just gave you so that you can check before you go get your credit pulled with the lender. Now it's time to get with a lender. So the best place to start is the place where you already are doing your banking. So if you're banking at a local credit union, that's great. The local bank that you've been with for a while is great. You just want to tell them, hey, I'm interested in, buying my first house, and I would love to see what it would take for me to get pre-approved. Again, don't give the bank any paperwork yet. Wait for the lender to ask you and then only provide to them specifically what they have requested. Don't ever give a lender more than what they ask for, ever, okay? So once you've started the pre-approval process with the bank, those papers will be right there. You'll be able to get everything to the lender really quickly. One thing I really want to make sure that most first-time home buyers do is to look for their Community Reinvestment Act loans in their community. Banks have them on the books. These are really super affordable loans. A lot of times they are conventional versus being government-backed, which is what a non-conventional loan is. It's either a government backing or a government insuring involved, which is great, but anything involving the government is going to have a little bit more red tape, a few more hoops to jump through, and some sellers tend to associate, delays and stuff like that with some government-backed or insured loans. It just is what it is. So if you are in a situation where you're wanting to be as competitive as possible, my recommendation as a broker is for you to find a conventional loan product, right, that is affordable for you. And if you're worried about having a big down payment, these loans that I'm talking about, these Community Reinvestment Act loan products, don't necessarily require a down payment, but they may require a stronger credit score. So the stronger your credit score, the better off your options are when it comes to buying your house. I'll talk to you more about the Community Reinvestment Act loans in another video, be sure to like and subscribe, and be sure to turn on that notification bell too so that you know when I post more videos that can help you get your first house. I'll talk to you soon. Peace.